All right, so we are going to be discussing receivables with Chapter 9. So our learning objectives for Chapter 9 are that we are going to define and explain common types of receivables and journalize sales on credit. Number 2, we're going to apply the direct write-off method for uncollectibles. Number 3, we're going to apply the allowance method for uncollectibles and estimate bad debt expense based on the percent of sales, percent of receivables, or the aging of receivables method. For our fourth learning objective, we're going to account for notes receivable, including computing interest and recording honored and dishonored notes. We're also going to use the acid test ratio, accounts receivable turnover ratio, and days sales in receivables to evaluate business performance. So our first learning objective, we are going to define and explain common types of receivables and journalize sales on credit. I will point out that a lot of this is going to be some review. We've already journalized sales on credit before. Simply what we mean by on credit is like we purchased or sold something on account. So we'll be going over that a little bit more in depth and looking at a couple of different ways that we're going to deal with those different sales. So first, we're going to just define what a receivable is, and everybody at this point should know what a receivable is, but it occurs when a business sells goods or services to another party on account, so we're selling it on credit. This is simply just, we have sold something, and the other person has not paid for it yet, so it is considered a receivable. A receivable is an asset account. The receivable is a monetary claim against a business or individual. It just basically says that we have the right to claim money from that individual. The receivable is a right to receive cash in the future from a current transaction. And within that, there are two different individuals involved. You have the creditor, who is the party who receives the receivable, so the person who sells something, and then you have the debtor. This is the party to the credit transaction who is obligated to pay later. So this is the person who bought that good or service from us. So now we're going to talk a little bit about accounts receivable. We've already discussed accounts receivable in the past. We should all know what this is. So this is money that we are going to receive in the future from customers for goods or services that we have sold or services that we have performed. Generally, accounts receivable is collected within 30 to 60 days, 30 days being the most common, 60 days being kind of the outlier there. We record accounts receivable as a current asset on the balance sheet. The reason why it's a current asset is because we could conceivably convert our accounts receivable into cash within 1 year, which would make it a current asset. Then we also have notes receivable. Usually these have longer terms than accounts receivable, so a note receivable is typically just considered a long-term asset. Essentially, this is a loan that we've given to someone and they need to pay us back plus interest by a certain date. That date is referred to as the maturity date, and that is the date on which the note receivable is due to us. We have other receivables as well. We can have dividends receivable, interest receivable, taxes receivable, but the most common that we're going to utilize is just the accounts receivable and potentially the notes receivable as well. So as we discussed in Chapter 8, we also have to have internal control over our receivables, and we talked about these a little bit. Basically, the biggest one here when we discuss receivables is that we're going to have a separation of duties from the individual who handles the cash and the individual who actually does the accounting for cash that is received. Again, we just have to have that control in place to make sure nothing funky happens and that we're keeping people as honest as possible. So when we record a sale on credit, we have an example here where Smart Touch Learning provides $5,000 in services to Brown on account and sells $10,000 of merchandise inventory to Smith on account on August 8th. In this case, we're going to ignore cost of goods sold for the purposes of this example. So we see our two journal entries here. Both of them took place on August 8th. And we see the biggest difference here from when we would normally record an accounts receivable to this one is that we are very specifically identifying who our customer or client is in this case. So for the first one, the $5,000 in services that we provided to Brown, we see accounts receivable Brown is debited for $5,000 and then service revenue is credited for $5,000. It looks very similar to a journal entry we've done many, many times. The biggest difference here is that we're specifically identifying the customer in this case. For the other one, we've got accounts receivable Smith, and that's a debit for $10,000 and then a credit for $10,000 to sales revenue for those goods that we sold on account. So these go into, these two individual accounts receivable accounts for Brown and Smith go into what we call a control account. We consider those two separate accounts to be subsidiary accounts, which basically just means they're under this overall umbrella. So they're under this umbrella of accounts receivable. Each one has its own balance, and then the big accounts receivable account has its balance as well, which is the combination of those two. And you can see this in many businesses. Some businesses will just have a couple of accounts receivable. Other businesses will have many, many accounts receivable. So they have to be able to keep track of who owes them what, and that's why we use the subsidiary accounts. So they're just those little accounts that are kind of under this big umbrella of the accounts receivable. So when we get cash from these customers, this is kind of the way that that would look. So when the business collects cash from both customers, on August 29th, we get $4,000 from Brown and $8,000 from Smith. Smart Touch Learning will make the following entry. So we're going to debit cash for $12,000, which is the total amount of money that we received, and then we'll credit each of those individual accounts for the amount of money that they gave us. So $4,000 is credited to accounts receivable Brown, and then $8,000 is credited to accounts receivable Smith. So it reduces the balance in those accounts receivable accounts for both of them respectively. So we see the T accounts here to kind of show you what just happened there. So we received $4,000 from Brown, and we see now that in the accounts receivable Brown account, there's now a balance of $1,000, and in the accounts receivable Smith account, we received $8,000. So now there's an existing balance of $2,000, with that overall balance now being $3,000. So some of the things, one of the biggest downfalls with accounts receivable is the risk that we could not be able to collect that money. And that happens quite frequently in the business world, and we call those bad debts. So some of the things that we can do to kind of mitigate that risk and to control that risk of not being able to collect on those accounts is that we can take different methods, or we can issue different methods and different types of credit to customers to kind of slow that. So one of the ways is making sure that we have a credit card or a debit card on file, so that if they owe us money, we can simply run the card on a monthly basis for their payments, or when they make the sale, so that we get our money as well. And then we can also factor and pledging receivables are other ways as well. So in the event that we are not able to collect on receivables, we have to look at different ways that we can write off those receivables, so they're not just sitting on our books for years and years and years and years. And the first method that we can utilize is the direct write-off method for uncollectibles. I will state that the direct write-off method is not the best method to utilize when writing off uncollectible receivables, but we'll talk more about that here in just a second. So we have what is called bad debt expense, and this is from when we are not able to collect from customers. And it could be through no fault of our own. It could just be what happens. They could already know when they make the purchase that they have no intent on paying us, but we gave them that good faith credit, and now we've got to deal with the fact that we're not going to get that money. So there's two different ways that we can do that. We have the direct write-off method, again, not the best method, but it's there. And then we have the allowance method, which is GAAP approved. So it's under the generally accepted accounting principles that we can utilize that method. So we're going to talk about the direct write-off method first. That direct write-off method is a method for accounting for uncollectible receivables, in which the company records the bad debt expense when a customer's accounts receivable is uncollectible. So we typically will use the direct write-off method when the business is pretty small and it's a non-public entity, and usually when they have very few receivable accounts. So this would just be a very small business. They don't have a whole ton of customers that they issue credit to, and we write it off directly, as a direct write-off for that account. So in this case, on August 9th, Smart Touch Learning determines that it will not be able to collect $200 from customer Dan King for a sale of merchandise inventory made on May 5th. So on August 9th, they decide they can't collect this. So they're going to go ahead and debit their bad debt expense, $200, and credit their accounts receivable. And that essentially just takes that accounts receivable right off their books. They don't have it anymore, but it did increase their expenses by $200 in the form of bad debt expense. So it's still an expense to the company when somebody doesn't pay. It's money that we're losing out on. And so this is the direct write-off method. We know we can't collect that account, so we're just going to go ahead and directly write that off right away to bad debt expense. Now, sometimes what could potentially happen is that customer could say, even after we've written it off and everything, they could say, oh, hey, wait, I owe you this money. I need to pay you. And that's what happened here with Smart Touch Learning. On September 10th, they received $200 unexpectedly from Dan King. So they have to reverse that write-off entry that they did. So they go ahead and debit accounts receivable King and credit bad debt expense to increase the accounts receivable again and decrease that expense. And then they record the cash that they received. So a debit to cash to indicate we received the cash, and then a credit to accounts receivable once again to kind of close out that account. So there are limitations to the direct write-off method. It violates the matching principle. So that is one of the reasons why we can't really utilize it except for in very small non-public businesses. So essentially what happens is that, let's say a company records sales revenue in 2017 and related bad debt expense in 2018. Essentially, this results in an overstatement of net income for 2017, an understated net income for 2018, and overstated accounts receivable in 2017 as well. So that's why we can't use the direct write-off method because it results in these over and understatements that we just can't have. So it's only acceptable for companies that have very, very few uncollectible receivables, and like when they're super, super confident that they will not be able to collect on that. So we have an alternative method that we can utilize. So in this case, we're going to use the allowance method for uncollectibles. And there are 3 different allowances that we can take. We can use percent of sales, percent of receivables, or the aging of receivables methods. And we're going to go through all 3 of those. So most companies will use the allowance method to measure their bad debts. The allowance method is based on the matching principle. So basically what happens is we determine, okay, we're going to give an allowance for the amount of bad debt that we could potentially have within a year. And that's recorded in a contra asset account. So remember, a contra account behaves just like an asset account, except it's opposite of it. So in order to increase an asset account, we typically debit it. To decrease it, we typically credit it. In this case, for a contra account, we do the opposite. So to increase the allowance for bad debts, we're going to credit it, and to decrease it, we're going to debit it. So for this one, we're going to utilize the allowance method. So on December 31st, 2019, Smart Touch Learning estimated that $80 of its $4,400 in accounts receivable are considered to be uncollectible. So we need to account for that. So what we're going to do is we're going to go ahead and debit bad debt expense, and we're going to credit allowance for bad debts. So what this does is it increases our bad debt expense, so it increases that expense, and then it also increases our allowance for bad debts. Remember, allowance for bad debts is considered an asset account, but it is a contra account, so it behaves opposite of a traditional asset account. So this is just a little snapshot of the balance sheet and kind of how this would look for the assets. So we have our accounts receivable, and then we have that contra account. So it's always going to say less allowance for bad debt. So it responds a lot like the depreciation accounts behaved when we looked at those a few chapters ago. So that allowance for bad debt is going to be a negative number, and it's going to essentially reduce our accounts receivable number. So accounts receivable is $4,400, but we reduce it by our allowance for bad debt, which is $80, so we end up with receivables of only $4,320. So once again, when we're writing off those uncollectible accounts using the allowance method, we need to have a way to establish that allowance. So there's a couple of different ways that we do that, and instead of just recording a debit to bad debt expense, the company records a debit to the allowance for bad debts. And the entry to write off on the account under the allowance method has no effect on the net income at the time of entry. And that's the big point here, is that we don't want it to have an effect on our net income for the period. So in this case, we are going to write off this account. So on January 10th of 2020, Smart Touch Learning determined that it cannot collect a total of $25 from its customer, Sean Clark. So we're going to go ahead and write this off. So it's going to be a debit to the allowance for bad debts and then a credit to the account receivable for Clark. So it reduces the account receivable for Clark, and then it also kind of, in essence, it reduces that allowance for bad debt, but we'll see here in just a second, it ends up having like a net zero effect. So here we see it before the write-off and then after the write-off. So that $25 write-off that we just took. So before, our balance sheet looked like this. We had accounts receivable of $4,400 and we had the allowance for bad debt expense at $80. It is a negative $80. And then our net realized value of our accounts receivable was $4,320. After the write-off, we see our accounts receivable has decreased by that $25. So now it's just $4,375. And then our allowance for bad debt is that negative $55, which gives us a net realized value still of $4,320. And this is the big thing. We want those numbers to stay consistent unless we're actually like receiving money from a client or a customer. So the recovery of accounts previously written off, we can still do that just like we did with the direct write-off method. We can still do that. So in this case, on March 4th, we unexpectedly received that $25 from our client, Sean Clark, and so we need to account for that. So once again, we're just going to reverse that previously written off entry. So we're going to debit accounts receivable Clark and credit allowance for bad debts. And then we will just receive that money just as we normally would. So it'll be a debit to cash and then a credit to the accounts receivable for Clark. When we are getting ready to estimate our allowances for bad debt expense, we can use several different variables that we have on hand. So we can estimate them based on past experience, on the industry in which they operate, and other variables to take into consideration. So it could just be simply how the economy is doing at the time, those types of things. But the biggest indicators are going to be past experience, especially for well-established companies. So there are three different methods that can also be utilized, and that's the percent of sales, the percent of receivables, and the aging of receivables. So the first method that we're going to look at is the percent of sales method. So this computes the bad debt expense as a percentage of the total credit sales. Some companies will use all of their sales, not just credit sales, but for the most part, they'll just utilize their credit sales or their historical credit sales as well. So this method can also be called the income statement approach, and we'll see why here in just a second. So when we use the percent of sales method, basically what we do is we just take our net credit sales and we multiply it by whatever percentage we've decided we will deem as uncollectible. So in this case, we're going to look at our uncollectible sales being, half a percent, so 0.5%. Of our total credit sales for the year, which was $60,000. So all we have to simply do is take $60,000 and multiply it by that half a percent. So 60,000 times 0.005, and that gives us $300. So when we're looking at the percentage sales method in this case, we're going to say that $300 of our $60,000 in credit sales we are going to deem as uncollectible. We're not going to be able to collect that from our customers. And that's a relatively low number, and if I were a small business owner and I only had uncollectible sales of $300, I'd be ecstatic. So we need to record this allowance. So all we have to do is take a debit to our bad debt expense and then a credit to our allowance for bad debt. So we can see here our T accounts, we see our accounts receivable account there, we see our allowance for bad debt, and we see that we have adjusted that for $300 to the existing $55 we already had there, and then we have our bad debt expense is also going to increase by $300 here. So the second method that we can use to determine our allowance for our bad debt is the percent of receivables method, and this involves a couple of different steps. So the first step that we do is we have to determine the target balance of our allowance for bad debts. So in order to do this, we take the ending balance of our accounts receivable and we multiply it by whatever percentage we've determined is going to be suitable for our uncollectible balance. And then once we have our target balance, then we need to determine the amount of bad debt expense by evaluating the allowance account. So what we'll do is we'll take that target balance and we'll take the unadjusted credit balance for the allowance for bad debts, and this will give us our bad debt expense. Or we take the target balance plus the unadjusted debit balance for our allowance for bad debts. Typically, the allowance for bad debts should have a credit balance in it, but sometimes it has a debit balance if the amount of written off bad debts exceeds what our allowance was for the period. So this is an example of that percentage of receivables method. So on December 31st, 2020, Smart Touch Learning's unadjusted accounts receivable balance of $6,375. And then they determined that 4% of accounts receivable is estimated to be uncollectible. So the allowance for bad debt account has a credit balance of $55, so the adjustment is $200. So when we look at our balance of our accounts receivable, we need to multiply that by our 4%. So $6,375 times our 4%, so times 0.04, is $255. So we need to have a total of $255 in our allowance for bad debts account, and currently there's $55 in there. So essentially what we need to do is we need to add another $200 to that allowance for bad debts. And that is done by the following journal entry. So this is the journal entry that we would utilize for that. So we would take a debit to our bad debt expense of $200 and a credit to the allowance for bad debts of $200. And again, that just brings it up to that $255 mark that was our target. So we can see this here again, just all of the T accounts that we've utilized. So we've got our accounts receivable with its balance of $6,375. We determined that 4% of that is uncollectible, which is $255. We had to make the adjustment to our allowance for bad debt expense to increase it by $200. So we credited allowance for bad debt expense for $200, and then we went ahead and debited our bad debt expense for $200. So what happens if we have a debit balance in our allowance for bad debts? So this is an example of that. So Martin's Music has a debit balance in its allowance for bad debts accounts of $150, and it estimates that its uncollectible accounts will be 2% of its $40,000 of accounts receivable. So we need to figure out what 2% of $40,000 is. So we multiply 40,000 by 0.02, we get $800. From that $800, we should have a credit balance in our allowance for bad debt expense of $800. So we need to determine how to make that amount $800. So we have a debit balance of $150, and we need for it to have a credit balance of $800. To do that, we need to credit the allowance for bad debt for $950, and that's simply that $800 plus the existing $150 debit balance. So our journal entry looks like this. It is a debit to bad debt expense for $950 and a credit to the allowance for bad debts for $950 as well. All right, so the last method that we're going to utilize to figure out our allowance for bad debt is the aging of receivables method. For the aging of receivables method, this works a lot like the percent of receivables insofar as that it uses different percentages. However, the difference here is that we are going to assign different percentages to each of the different categories. And that is present here. So if we look here, really we're looking at the bottom of this page. So we see all of the different customers there, and then we see the totals for our accounts receivable. So for 1 to 30 days, we have a total of accounts receivable of $4,245, and we estimate that 1% of that will be uncollectible. For our 31 to 60 days, we have $830 total owed to us, and we estimate 2% of that is uncollectible. 61 to 90 days, total of $1,200, and we estimate 3% is uncollectible. And then over 90 days, we have $100 in accounts receivable, and we estimate that 90% of that would be considered uncollectible. So for each of those different lanes there, we calculate what our estimated uncollectible is. So of the $4,245, 1% or $42, $830, 2%, or $17, $1,200, 3%, or $36, and then the $100, 90%, or $90, for a total uncollectible of $185. So with those different percentages, how do we kind of figure that? So really what we want to do is we want to determine the target balance of the allowance of bad debts based on each of the ages for the different accounts. And then we'll determine the amount of bad debt expense by evaluating the allowance account. So we'll look at the bad debt expense account, we'll figure out what our target balance is for that, and then we'll subtract the unadjusted credit balance of the allowance for bad debts, or add the unadjusted debit balance of the allowance for bad debts. So that's going to look like this. So we have a target balance of $185 in our allowance for bad debt account, and so we need to get it to that point. So in this case, we're going to look at what our existing balance is, which is $55, and it's a credit balance. And so from there, we are going to go ahead and add $130 to our allowance for bad debt. So you see our journal entry here. We have a debit to bad debt expense, and then a credit to the allowance for bad debts for $130. And you can see the T account and the journal entry there. All right, so continuing on with this, we can see all three T accounts here. So we see the accounts receivable account, we see the allowance for bad debts with the adjustment, and then the bad debt expense that also includes our adjustment of $130. So this just kind of shows the difference in the journal entries from utilizing the direct write-off method that we talked about at the beginning, and then utilizing the allowance method. So this just kind of shows a comparison of accounting for the uncollectibles utilizing the three different methods that we just talked about. So the percent of sales, percent of receivables, and the aging of receivables method. And just kind of how those work. So take a look. I'll pause for a second. So our fourth objective here is that we are going to account for notes receivable, including computing the interest and recording the honored or dishonored notes. So how do we account for notes receivable? So we have a promissory note, which is a written promise to pay a specified amount of money at a particular date in the future, usually with interest. Y'all, it's just a loan. The maker of the note, so the debtor, is the entity that signs the note and promises to pay the required amount. The payee of the note is the creditor. They're the ones who are loaning the money, essentially, and they are the ones whom the future payment is due to. The payee of the note is the creditor. Okay? It could be a company, it could be an individual, it's just whomever loans that money. There are a few different things that are integral to a promissory note or a loan in this case, and a lot of these things you probably have heard before. So principal is the original amount of the note or of the loan. So this is the amount of money that is actually asked for, and that's the principal amount that needs to be paid back. Then you have the interest. This is the revenue to the creditor, to the payee. So it's the money that they're going to make on that loan. So interest is usually said as a percentage. And then you also have the interest period. This is the period of time during which interest is computed. So it's for however long the note is for. We also call this the note term. So how long are they going to borrow that money for? So how long are we going to be receiving interest for? You have the interest rate. This is the percentage rate of the interest specified by the note. So it could be 2%, 3%, 4%, 10%, 28%, whatever the case may be. Then we have maturity date. This is the date when the final payment of the note is due. So that note could be due in a lump sum, or that note could be due in small payments, kind of like a car payment. And then we have the maturity value. So this is the sum of the principal plus the interest due at maturity. So oftentimes now when you go get a loan, they'll tell you exactly what the maturity value is. So how much are you actually going to be paying for that loan? How are notes receivable accounted for? So this is kind of what that promissory note will look for. Again, it just shows, you know, how much it's valued at and when they're going to promise to pay and what that interest rate is. So for this one, it's going to start on September 30th of 2019. It's for $1,000. We see the principal in the upper left-hand corner there. Who is it being paid out to, or who do they promise to pay? When do they promise to pay it? In this case, it's 1 year later, and then it's signed by the individual who is taking out that loan. So this is how we record that loan. So Smart Touch Learning lends Lauren Holland $1,000 in September 30th, 2019 for 1 year at an annual interest rate of 6%. So we see notes receivable Holland, $1,000, credit to cash, $1,000, because we gave Lauren that cash, that $1,000. Some notes specify the maturity date. Other notes state a period of the note in days or months. So especially with like car loans and that type of thing, you won't necessarily see like the final date on the promissory note, but you'll see like, 30 monthly payments or 36 monthly payments or 24 monthly payments or 62 monthly payments, whatever the case may be. And it could also be in days. And usually that'll be for shorter term loans that they'll actually just say how many days is there. Okay, so for this one, a 180-day note dated February 16th, 2019 matures on August 15th, 2019, and it's shown here. So we see this for each month. So this one shows the days. So how do we compute the interest on a note? So it's a relatively simple formula. So we have the amount of interest is equal to the principal times the interest rate times time. So this is a very common formula. You've probably seen this before. It is just how you calculate that interest. For the time, it could be expressed as a fraction, or it could be the number of days as a fraction as well. So it could be 3 divided by 12. That means that it's 3 months. Or it could be written as days as a fraction over 365. So utilizing that formula, interest equals principal times interest rate times time, we're going to look at the initial loan that we talked about. This is the one where they loaned $1,000 at 6% for 1 year. So we need to figure out the amount of interest. So it's $1,000. The interest rate is 6%. When we multiply by the percent, we're going to convert it into a decimal, so 0.06 for 6%, and then it's for 1 year. So we could either do 1 year or 12 over 12 or 365 over 365. Either is fine. So then we take 1,000, multiply it by the 0.06, and then multiply it by 1, and we get that the amount of interest that will be owed to us is $60. For a $2,000 note at 10% for 9 months, it's computed as follows. So we have $2,000 times the 10%, which is 0.10, times 9 divided by 12, and we get 150. Okay. A $5,000 note at 12% for 60 days can be computed as follows. So 5,000 times the 12%, or 0.12, times 60 divided by 365. Remember, that's how we calculate the days, and we get approximately $98.63. When we are dealing with interest, we will always round to 2 decimal places, and we will always use traditional rounding rules as we are dealing with money. So make sure that you are paying attention to that. 2 decimal places, y'all. To record the interest that is receivable, this is how we would go ahead and do it. So we're looking at that $1,000 loan again at 6%. And we're looking at the interest that would be due on December 31st. So we look at 3 out of those 12 months. So we issued the note in September, and now they're going to pay the interest, or we're going to look at the interest that is receivable through December. So it's only for 3 months out of those 12. So we can either take that $60 and divide it by the 12 months and then multiply that by 3, or you can simply redo the interest calculation and take the $1,000 times the 6% times 3 over 12 because it's only been 3 months. And then we'll record this interest as a receivable. So we have interest receivable on December 31st of $15, and so it's a debit to interest receivable and a credit to interest revenue for $15 as well. So this is kind of a really good visual to show you kind of where that $15 is coming from and all of that. So when we look at this timeline, we see at the beginning, September 30th, 2019, and all the way at the end, we see September 30th, 2020. When we were looking at the previous problem, we were looking at just those first 3 months, and you kind of see that. So you see where it says the accrual here. So right here, we've got the accrual right for December 31st that we just figured. So that's just 3 months, and and for that we only have $15 receivable in interest. And then the remainder of that time period, so the remaining 9 months, we can utilize this equation here, the $1,000 times the 6% times 9 divided by 12, and that tells us that we have another $45 of interest receivable. So on the maturity date of this loan, so on September 30th, 2020, Lauren goes ahead and pays us our $1,000 plus that interest, okay? So this is what that journal entry would look like. So she's going to go ahead and pay us the $1,060. So that's the 1,000 times the interest rate times the 12 divided by 12, and we add that to our initial principal value of $1,000. So she gives us $1,060. Our notes receivable is credited for $1,000 because it's been paid. The interest receivable that we recorded at the end of our year on December 31st of $15 is paid, and the additional $45 in interest revenue is also paid, and that balances our journal entry here. So we are good to go. So it is a multi-step journal entry. It does have 4 different accounts that it utilizes, but we're just bringing those receivable accounts to 0, and then we're also calculating for the interest, the additional interest that we received at the end of the maturity period. So here is another example. On July 1st, 2019, Rosa Electric sells household appliances for $2,000 to Dorman Builders. Dorman signs a 9-month promissory note at 10% annual interest. So this is how they would record that transaction. So remember, this is a 9-month note. So we're going to record the note receivable, so it's a debit to notes receivable, Dorman Builders for $2,000, and a credit to sales revenue for $2,000 as well. At the end of the year, we've got to account for the interest that we have receivable on that note, so we have this calculation. Remember, this purchase was made on July 1st, so all the way through December 31st, that is going to be about 6 months of our 9-month note here. So interest receivable is calculated as $2,000 times that 10%, or the 0.1, times 6 divided by 12. And that gives us $100 of interest that we are owed. So we are going to debit interest receivable and credit interest revenue for $100. Then on April 1st, they go ahead and pay off their note receivable here. So we receive cash of $2,150, and this is accounting for that 10% interest over the course of those 9 months. So we have a debit to cash for $2,150, a credit to notes receivable for $2,000, a credit to interest receivable for $100, and a credit to interest revenue for $50. Okay, so here is another example for accruing interest revenue and recording the honored notes receivable. So Sports Club cannot pay Blanding Services the amount due on accounts receivable of $5,000. Blanding accepts a 60-day $5,000 note receivable with 12% interest on November 19th, 2019, and the journal entries will look like this. So we record the note receivable on November 19th, so notes receivable increases by $5,000, and accounts receivable actually decreases by $5,000. So we converted that accounts receivable into a note receivable because now we're going to be earning interest on it. So then on December 31st, we have to account for the interest that we've accrued to that point. So on December 31st, we record the interest receivable as $69. The way that was found is we took our $5,000 principal, multiplied it by our interest rate of 12%, so 0.12, and then multiply that by 42 divided by 365. Because this is a 60-day note receivable, we need to figure out how many days have passed. So we simply count the dates from November 19th through December 31st, and we get 42 days. So we end up with $69 of interest receivable, and we also credit interest revenue at that point, and then on January 18th, the note becomes due. So Sports Club goes ahead and pays us the $5,000 plus the interest that they owe us at that time. So we take our $5,000 and we figure out what our total interest would be. In this case, it's $99. So we have our cash debit of $5,099, and then we credit notes receivable to get rid of that, interest receivable to get rid of that, and then we record the additional interest revenue that we have earned for these last 18 days here, which is $30. So now we're going to talk about dishonored notes receivable. So when a maker dishonors a note, the dishonored note and the unpaid interest are transferred to accounts receivable. So basically what dishonored means is that they haven't paid us in the way that they should. Later, the accounts receivable can be written off under the direct write-off method or the allowance method. So basically what this means is that we loaned somebody money and they decided to stiff us and they didn't pay us. So this is kind of what that looks like. So we're going to go ahead and record this dishonored notes receivable. So we're going to suppose that Rubenstein Jewelers has a 6-month 10% note receivable for $1,200 from Mark Edier that was signed on March 3rd, 2019. Edier defaults, which means that he didn't pay. Rubenstein Jewelers will record the default on September 3rd, 2019 as follows. So they take the accounts payable and they're going to go ahead and debit that. So we're accounts receivable for Edier. So we're going to go ahead and create the accounts receivable for him for the total amount that he owes, which in this case it's $1,260. Then we credit notes receivable and interest revenue at this point. So it gets rid of the notes receivable and it kind of gets rid of that interest revenue as well. So learning objective 5, we're going to use the acid test ratio, accounts receivable turnover ratio, and days sales in receivables to evaluate business performance. So how do we use these to kind of evaluate the business performance? So basically what we're going to do is we're going to take a look at the balance sheet data to determine the relationships among our assets, liabilities, and revenues. So we use these 3 different ratios to kind of help us determine like how the business is doing. So we have the asset test ratio, the accounts receivable turnover ratio, and the days sales in receivables. So we're going to use this like snapshot of Kohl's as per usual. So all of the amounts here are in millions. So we've got the current assets section of our balance sheet, and then we have our total current liabilities as well. This is an example of the Sears information. So we have pretty much the same information from Sears as we did from Kohl's. So the acid test ratio, or the quick ratio, is used to measure a company's ability to pay its current liabilities. So we're going to take a look at our current assets versus our current liabilities to determine how quickly we would be able to pay those liabilities if need be. So quick assets are considered things like cash or cash equivalents, short-term investments, and net current receivables. So anything that we can convert to cash within a relatively quick time period. The higher asset test ratio, the more able the business is to pay its current liabilities. In general, the asset test ratio of 1.0 or higher is considered safe. So anything below 1.0, and we're getting into some dangerous territory, because that would mean that we wouldn't have enough cash to cover the liabilities that we currently have. So in this case, we're going to go ahead and look at this for Sears Holding Corporation, and we're going to look at their asset test ratio. So we take all of our cash and cash equivalents plus our short-term investments plus our net current receivables, and we divide it by our current liabilities. Okay, so with that, we get 0.12, and this is rounded. So the business has 12 cents of quick assets to pay each dollar of current liabilities. Y'all, this is not a great quick ratio. Like this is actually pretty bad. This means that for every dollar that they owe somebody, they actually only have 12 cents that they can pay on that. Remember, we want this asset test ratio, or the quick ratio, to be 1.0 or higher to be considered safe. So Sears is not doing so great. Then we're going to look at the accounts receivable turnover ratio, and this measures the number of times the company collects the average accounts receivable balance in a year. So it's how quickly are we collecting those receivables that we have and converting them to cash. So in order to do that, we're going to do this for Sears again as well. So we take our net credit sales divided by our average net accounts receivable. So we get 59.31 times per year. So that means we're turning over our receivables 59 times a year. So we're collecting on those at least 59 times a year. Days days sales and receivables, this will indicate how many days it takes to collect the average accounts receivable. So so we have somebody who owes us money, how long does it take us to actually collect on that amount? To figure that, we take 365 days and we divide it by our accounts receivable turnover ratio, which we just found previously. So in this case, we take 365 divided by our 59.31, and we get approximately 6 days. So on average, it takes Sears Holding Corporation 6 days to collect its accounts receivable. I mean, that's not bad. That's actually pretty quickly. And that's all we have for Chapter 9.